In the last video, we briefly discussed DSCR and how it is used when qualifying for a non-recourse loan. DSCR stands for Debt Service Coverage Ratio. This is the formula used by many lenders to analyze the cash flow for a specific investment property. For example, let's assume you want to buy a single-family home in your IRA that costs $200,000 a year and you want to borrow 50% of the purchase price, or $100,000. Let's also assume that the going market rent is $1,500 a month and the annual real estate taxes are $2,000, while your hazard insurance is around $700 a year. This graph breaks down the expenses NASB will use for a debt service coverage ratio calculation. Now you take the gross annual income and subtract out all the expenses listed. This will give us our net operating income. Now let's assume your interest rate is 7% and the loan's amortized over 25 years with a loan for $100,000. So your annual principal and interest payment is $8,482 a year. Next, we're going to divide the net operating income by the annual principal and interest payment, and this will give us our DSCR. You may want to pause the video at this time to look at the numbers closer. This specific property has a 1.48 DSCR, or 48% positive cash flow. 1.0 is the break-even mark. NASB is looking for a 1.25 DSCR greater. You can use this formula each time you analyze a different property. A NASB representative can also email you an Excel spreadsheet that calculates all the numbers for you. Please contact a representative at 866-735-6272, and you can also find more about this at IRAlending.com or by reading Chapter 4 of our book, Leverage Your IRA. Thanks for watching.